Are you curious about the current market sentiment and what's driving it? In today's episode, we'll trace the risk on and off sentiment through key indicators and delve into impact of data flow and provide a technical overview of precious metals and commodities in light of recent price movements. Hi, everyone. I'm Roy Güllüoğlu. Welcome to another episode of Market Update featuring by Marketsall and Rationale. Before we get started, make sure to subscribe to the channel. And if you find this video helpful, please give it a thumbs up. Also, if you have any questions, please leave us a comment in the video. We will be glad to answer. All right, yeah. Let me share my screen first. Yes. Let's begin with covering the economic calendar and review highlight events since our last video. First of all, April, the Bank of Canada maintained its key rate at 5% as anticipated, and refrained from hinting at potential rate cuts due to ongoing inflationary risks. The central bank observed the price pressures have eased across a broad range of goods and services since the last meeting. However, it also noted that the uncertain macroeconomic environment and higher than expected commodity prices, particularly oil, hindering a smoother path of disinflation. Okay, disinflation continues, but the pace is still questionable. As you can see, the CPI data here also supporting this easing. Month over month, it came from 0.5% to 0.2%, and year over year from 2% to 1.6%. Let me show you USD CAD charts in a technical site. Here, as you can see in the weekly chart, here it's consolidating really well in the weekly chart. There's a rectangle chart pattern, as you can see here, with a price target of a potential breakout. It might end in 1.46. But yeah, technically, generally rectangle chart patterns are sideways, go sideways. Then it might work as a continuation, or it might work as a reversal pattern. As long as it's above a 200-day moving average, that means the instrument is trending, and we might expect to see it to go higher. And with the expectation of Canadian Bank of Canada acts faster than the Fed, that might this a long trade idea might work, and that will be in line with the macro view. Yeah, let me come back to continuing with the continuing from Fed Waller speech. He mentioned that the progress toward 2% has likely resumed after the last inflation data. Also, he mentioned that he expects to see some moderation in economic activity, first due to the retail sales data in April, and that revised down in the previous 2 months. That's a distortion retail sales data. That's an indicator of consumer spending. And second, increasing credit card and automotive loan delinquency rates. It's above their pre-pandemic levels, which indicate a stress on spending levels. And on Wednesday last week, during in 2024 policy meeting in May, RBNZ, the Reserve Bank of New Zealand, maintained its cash rate at 5.5%, despite headline inflation falling to nearly 3-year low of 4% in Q1 2024. It remained above the target range of 1% to 3%. Therefore, the committee concluded that the rate needed to stay at restricted level to ensure inflation returns to the target range within a reasonable time frame. In UK, as you can see here, we received the CPI data. inflation, like it dropped to 2.3%, the lowest mark since July 2021. It's down from 3.2% in March. So this progress positions the UK or Bank of England ahead of other countries on the path of rate cuts, right? Also, in UK CPI data, although like a good side entered in deflationary territory, still like a service sector issue persists, as it's the same story with the US. But yeah, they seem like they had acted first during the rate hiking path, then they stopped. They managed a bit different than the rest of the world. Yeah, the existing home sales in US is crucial to see the impact of rate hikes on the demand on real estate. And any decrease in this number would be a positive for the risky asset, as it suggests sooner rate cuts. And one important highlight of last week was FOMC minutes was released, and it was like little was discussed beyond what we already know. Actually, it was highlighted that there was a significant attention given to the negative trend in the inflation data for the first quarter, indicating that it might take more time to build sufficient confidence on rate cuts. Here you can see that when you come to the minutes, and also like when you come to the Fed's page, when you find the April-May meeting, you can reach the minutes from here. And yeah, in the minutes, you can just jump to participants' view on current conditions and the economic outlook. As you can see, participants generally commented that they remained highly attentive to inflation risk. This is the part that I mentioned on Q1 inflation data. Yeah, they also remained concerned that elevated inflation continued to harm the purchasing power of households, especially. Yeah, you can read here. Yeah. And yeah, apparently coming from 6% inflation to 3%, sometimes like it was tough for sure, but coming down from 3% to 2%, maybe it's harder. Yeah, that's what we're experiencing right now, I guess. And other highlights of last week was Nvidia. Yeah, Nvidia, you can this is the announcement page, and Nvidia exceeded market expectation, and so the S&P 500. The details, you can reach the details. There's the quarterly revenue of 26 billion, up from 18%. Numbers are really great, but as a result, the S&P 500 ended the day with a decline. Actually, Nvidia closed the day 9% up, approximately 9% gain, and it has a significant weight on the on indices actually. In Nasdaq 100 index, for example, it also closed negative, and also semiconductor index that we need to check while we're speaking of Nvidia. Yeah, let me show technically where are we at there. First of all, Nvidia, as you can see, on Monday the market was closed, and this is the move. And as you can see here, sorry, you can take this as a a cup with handle. Maybe it comes here, then reverse back and breakouts. So technically it's a good spot, but maybe we may expect it to close this gap, then resume its trends. And when we come to that, the semiconductor in the index SOX, you can see that like that's concerning actually. Like Nvidia is going up, but it had a future of like carrying the market. But apparently, and with the earnings, rather than it shows a characteristic of carrying the market, it's just protecting the market right now, because like the major indices or the rest of the magnificent seven, or like the rest of the big companies, like did not like respond like super powerfully as it happened in Nvidia. But yeah, still like the positive earnings release for sure, like it's protected the market last week. And yeah, the risk sentiment on, let me come back to the calendar. And yeah, the risk on sentiment had come back with the, sorry, just I need to adjust something here. Yeah, the risk on sentiment had come back with the lower than expected ISM numbers. I'm here right now. I'll talk about some PMI numbers. Like the previous week, the risk on sentiment had come back with the lower than expected ISM numbers. Then the inflation number had supported it until the pre-Nvidia earnings. However, the service PMI last week came the highest of last 2 years, unlike the ISM numbers, and led to a negative pricing in risky assets. And currently, like the negative pricing in risky asset, it's like a good data. That means like a good data and bad pricing narrative is still intact. Like it's still that's why in that case, as you can see here, service PMI comes higher than expected, and we see that on Thursday we saw that the indices respond negatively. Let me show you here. Sorry, I was gonna show from here. And yeah, what was the date? 23rd. As you can see, this 23rd of the May S&P index, this negative bar. Yeah. On Friday, and also we received like a Michigan 5-year inflation expectation and consumer sentiment. Inflation expectations, also they released the 1-year inflation expectation, but since this, rather than inflation itself, it's expectation, the long term is more, we need to take that more into consideration. It's the lower than forecast numbers. That's a good sign, but the concerning part is here is the previous consumer sentiment is 77.2 and the actual one 69. This decrease is concerning. The consumer sentiment gives kind of people like the market's trust on the economy, and that's why it might be influential on US companies. In that manner, it's important. Yeah. Okay, let's go to the risk of sentiment side, especially after the VIX index hit the pre-pandemic levels. The market started to argue if the volatility is going to increase from this point, as the highlight of last week was the Iran president helicopter crash, and like that's why the market was expecting the VIX index to increase. So I would like to trace or validate this argument or this thought by checking some critical sentiment indicators. First of all, as you can see here in this chart, VIX is at pre-pandemic levels. Here is pre-pandemic levels. After that, this huge jump, and we came down to that level. So the VIX index also is a non-volatility index, is a measure of expected volatility in the stock market over the next 30 days. It is often referred to as the fear index, let's say. because it tends to rise when investors are concerned about potential market downturns, and fall when investors are more optimistic. So the VIX is calculated based on the prices of options on the S&P 500 index, and is used by investors and traders to measure, to gauge market sentiment and assess risk. So as it comes down, okay, that means okay. But when we see a jump over here, all these jumps probably coincides with some event, macro event. Second indicator is metric, let's say, put-call ratio. It is used by investor to measure market sentiment and assess potential shifts in direction. Actually, it is like a long or short direction. It's calculated by dividing the total number of outstanding put options by the total number of outstanding call options. So a high put call ratio suggests that investors are buying more put options and then call options. So this may indicate increased bearish sentiment or a perception of high risk in the market. High put call ratios are often associated with fear or uncertainty among investors, and you can see here there's a jump last week, and like a low put call ratio indicates that investors are buying more call options than put options, and this might suggest bullish sentiment or confidence in the market's upward direction. So low put call ratio are often interpreted as a sign of like optimism or like a bullish bias among investors. Yeah, as I mentioned, like this jump is concerning for the current situation. So another indicator is for the ones like looking for instrument providing some exposure to high yield corporate bond in the US, because like bond market is complicated. Like you can go and buy the ETF. There are like a huge variety of ETFs in the market, huge basket, and yeah, it's YG is one of them. It's another risk on and off sentiment indicator for me, as we see more inflow into high yield corporate bonds in a risk on environment like that. Like if people like if you trust the economy, if you think like high risk corporate bonds, corporate companies will do well, will do like at least okay, and the investment like money flows there, that means okay, it's more confident environment. So here in the attached weekly chart formed as you can see here, approximately 20-month long ascending triangle chart pattern as a bullish reversal after a downtrend. And I'm keeping an eye on this chart for a possible breakout. Rise in this chart would definitely indicate a decrease in risk. I mean, risk on sentiment will come back. So what was the start point of this? Like there in the market, there is an argument that okay, weeks came down. It might jump from here, Iran helicopter crash and stuff. But we need to validate through data, right? And we need to trace through some indicators. So this ETF, if it goes up, I would say that risk of sentiment is out of table. But put call ratio, this is concerning. So it's not. I mean, unfortunately, it's not like straightforward that you can understand from market that okay, I put tick on this indicator, tick on this indicator. But yeah, it's like driving a car. That's the challenging part of trading, to be honest. And one other indicator that I check is the GLD ETF. It's a gold ETF, which tracks price of gold. It's a popular investment choice for those seeking exposure to precious metal without owning physical gold. And the USO ETF is an exchange ETF that aims to track the price movements of crude oil future contracts. So it provides investor with a way to gain exposure to price of crude oil without directly trading futures contract. So why I'm looking like the ratio, an increase in this chart shows a risk aversion actually, because like since gold is known risk off instrument, and the oil is kind of, it's the thing that that help engines of the world to work. That means if there is a demand on oil, that means manufacturing is working, like the economy is solid and stuff. That's why it's more a risk on sentiment indicator. So if I check the ratio of it, it might give me some hint about where are we going. So here you can see there is a symmetrical chart pattern, and if we see this according to this indicator, this metric, let's say, a potential upward trend, if it resumes, that means risk of sentiment gain momentum. Yeah, as a result of these three indicators, like put call ratio, VIX index, volatility index, that too signals risk of sentiment. This gold and oil ratio would also support the idea in case of continuation of this breakout here, the breakout that I'm talking. Only high yield ETFs potential breakout. Let me come back there. I'm talking about this one. Only like potential that breakout contradicts with the idea of risk off. That's how you can trace the sentiment actually, these kind of indicators. Maybe I can add, you can also check, for example, consumer discretionary sector ETF divided by consumer staples, as one is like a more defensive, consumer staples is defensive sector, consumer discretionary is more luxury items and stuff. That's why, like, if the economy goes well in a risk-on environment, people would invest more discretionary side. That's why that ratio also might be a good indicator with this mentality. And lastly, I would like to take a look at a few charts of commodities and precious metals, taking into account the recent price movements. Like, just keep in mind that in an economic climate where real yields are being suppressed, we typically anticipate strong performance from precious metals, commodities, and equities. So with inflation progress stalling in the first quarter of 2024, real yields haven't been able to rise. And that's the primary factor influencing recent price movements, actually. And I will try to show how I follow some charts technically here. Let me first of all, let's start with the gold. Actually, I'm following this head and shoulder continuation. This is like a huge breakout, but this two bar, like this, like last month's bar, not that well. Yeah, especially here. If we come to weekly, I still expect some consolidation here, because still, like, due to inflation risks, it's not like omitted yet. That's why we need to see the real yields to come down to see like some further movements. And gold in a daily bar on Monday did a really it's like 4% up. It was 4% up. And first of all, let me show you what I'm following. Here's another HNS continuation. Okay, you can call it also cockpit handle, breakout, pullback, and the uptrend is still intact. And yeah, the price target seems here. So it's still positive movement. Well, I expect a positive movement. I mean, for a long-term investors, I think like trading this cockpit handle is really sensible. Also, you can, I mean, for example, this kind of game plan is really sensible. Just you can put the stop loss just under this 29.8. Let's say you can put stop loss here, buy here. Look, there's a really nice up until 35% 1 to 2 risk reward ratio. And yeah, this is legit, I guess. Yeah, this is really good trade idea. And yeah, real yields, as I mentioned, this is suppressed. Like when you check weekly, it's like this. Can you see this tightness? Like there's no directional move. Just to recall, what is this? Real yield means you need to subtract the inflation expectations from the 10-year yields. That would give the real yield. If there is an increase in this one, that means there's a high yield in a like riskless instrument. That's why if we see an decrease in real yields, we might expect to see some price increases in commodities and let's say precious metals and like also equities. Yeah, that's why it's pretty crucial indicator for me. The XY, as you can see, this channel lower bound, like lower here, this really nice parallel channel, and this uptrend still intact. I'm keeping an eye on here. But yeah, for the commodities, I want to show you this one. This is Goldman Sachs Commodity Index, and I think it has also an ETF as far as I know. As you can see, there's a really clear rectangle chart pattern is forming here in the weekly one, and when you come to the daily, there was a really, I would say, clear ascending triangle after a downtrend. So I would say that in commodities, this uptrend still intact. And when I come to the higher time frames help me to examine if the product, any kind of thing, any kind of instrument that I check, and that gives me opportunity to understand if this thing is expensive or cheap. Like in general, where is this center? Is there any room to go further? And when you see like commodity index, it had seen like before 800 levels. I mean, we have still room to go higher. And yeah, copper futures, here you can see rectangle chart pattern breakouts. It moves here. Yeah, here's a resistance. We might expect to see some consolidation here, and it might form a cup with handle formation here. So in such movements, there is two ways to position yourself. First of all, you can wait for a breakout here. You can establish a game plan like this. Let me do it like this. This is one way, I guess. And secondly, by following moving averages. This is, by the way, 10-week and 40-week. These are like long-term moving averages, which are crucial for me to validate the direct, like the trend, the current trend. The second one is you can just try around here by getting confirmation through this moving averages. Yeah, I think copper, and if rates are going to come down, that means like economy might do better, and copper would move well as a risk-on instrument. Aluminium futures, it made its movement actually after as you can see, there's a triangle here where it broke out and moving well. This is also weekly. I'm showing weekly right now because it gives more. It helps to understand the main trend. Higher time frames are better in that sense. Oh, I think that was another. This is Indian index exchange, I guess. Yeah. Okay. And here, crude oil. That's how I follow this one. I had a head and shoulder bottom here. It moved well up until here, but without reaching the price target, it came down. And since they got back to like below short-term moving averages, the red line is 200-day moving averages, black line is 21, and blue line is 50-day moving averages. I mean, I wouldn't be a buyer in this terms, let's say. I want to be buyer in any kind of instrument. At least I mean, they need to try to go just up to the short-term moving averages. That's at least short-term moving averages. At least I want to see, let's say, 200-day moving averages should be suppressed. And yeah, corn futures. As you can see, in all commodities, there has been a downtrend, then consolidation, and some of them made the move after the consolidation after a downtrend, and some of them have still room to go up. And I think corn is one of them also. There's a really nice tight a breakout. Yeah, the second resistance is going to be here probably. And if we see just a price increase above 200-day moving averages, this movement might gain momentum. And lastly, I would like to show coffee. Where are we right now at coffee? Yeah, look, again, same story. Downtrend. Here in the daily chart, you can see better this HNS bottom. I had given this as a trade idea in Rationale newsletter. And yeah, here you can see nice breakout. What a move. From here, it gained 44%. And in the weekly chart, you can still trade this weekly chart because pullback, okay, it eliminated this support a bit, but as you can see, it's still the 40-week moving average. This red line still carries it. That's why it means that, okay, there's still support around this level. So a game plan like this also makes sense, I guess. Yeah, these are some more patience game since it's weekly, and yeah, you need to wait. But yeah, for the long-term investors, these are a nice trade ideas, I guess. And yes, before closing the video, I would like to show through a calendar for what are the highlights of for the rest of the week. So today we're going to receive CB consumer confidence. This is crucial. It's like a Michigan University Consumer Sentiment Index. This is same mentality. It gives some hints. It gives hints about about the confidence of market on economy. That will be important. There are again FOMC members' speeches. Dali is going to speak. Then we're going to receive GDP preliminary number. That's crucial. And apart from that, yeah, here is the highlight of the week. We're going to receive core PCE index, and we'll talk about the on Friday, and we'll talk about the details in the next video. So that's all I'm going to talk about this week. I hope you found the information valuable. If you enjoyed what you watched, please consider subscribing to our channel for more content like this to support us. And don't forget to hit like button. Thank you for watching, and please leave comments if you have any question. We will be glad to answer. And yeah, we'll see you in the next one. Have a good one.